Hi guys, welcome to A Simpler Approach. If you are new to the channel, please subscribe, like, comment, and share. Today, we will be looking at partnership accounting. Let's get started. We have 4 topics to cover today. The concept of partnerships. What are the advantages and disadvantages of a partnership agreement? What are the financial statements for partnerships? And the capital accounts used for partnerships. I believe we all know the saying, teamwork makes the dream work. And with that concept, we can begin to understand what partnership is all about. It is a business entity that is owned and operated by 2 or more persons. And like any other business, the purpose of a partnership is to make profits. It is very important for persons with the intention of forming a partnership business come together and sign what is called a partnership agreement or a partnership deed. It is a contractual document that outlines the terms and conditions of the partnership. It includes contents such as the capital that is contributed or will be contributed by each partner, how profits and losses are shared, the rate of interest calculated on capital each year, if there is one, a rate of interest charged on drawings, if there is one, salaries that may be paid to a partner or both partners or all partners, if that is allowed by each partner, and what happens if a partner should die, if a partner decides to leave the partnership, or if there is an intention to add a new partner to the existing agreement. All these things are outlined in the partnership agreement. If there is no partnership agreement between the partners, then the Partnership Act, which is an official legislation, the Partnership Act provides the following conditions. Profit and losses are shared equally. There is no interest on capital. There is no salaries allowed. And there is no interest charged on drawings. Now, if the partners do not agree with this aspect of things purported by the Partnership Act, then it is advised that they have their own partnership deed. Advantages of a partnership. Capital is introduced by each partner. Unlike the sole trader, where capital is introduced solely by the sole trader, in a partnership agreement, that responsibility is shared. Also, each partner brings to the table either skills, competencies, or even resources. So everything does not rest on one person. And the responsibility for the development of the partnership is shared by each partner. So you can have a situation where one partner deals with the administrative aspect of things, one deals with the financial aspect of things, one deals with production and sales. So you find that each developmental area is shared and then they all come together. The disadvantages, however, are that profits are shared. Naturally, we can understand that. Decision making is also slow. Why? Because each partner has to agree unanimously before an action can take place. And lastly, the actions of one partner affects all partners. So if one of the partners should go rogue and go off and make a decision on his own, and let's say that decision was not entirely a good one, the effect of it will not only affect the rogue partner, but it will also affect all partners. There are 3 key financial statements for partnerships. The first one you should already be familiar with, and that's the income statement, otherwise known as the trading profit and loss account. The second one is the appropriation account, and that account is necessary because it deals with specific things that relates to partnerships. Now, on your screen, you are looking at the outline for the appropriation account. Notice what it starts with. That looks familiar. Does it not? It should, because the income statement ends with net profit, because remember, that's the purpose of the income statement, to calculate net profit. Now, by virtue of the fact that the appropriation account starts with net profit, it means that everything above net profit remains the same. The income statement as you know it remains the same. Now, it is possible to prepare an income statement and appropriation account. That is where you would start from sales all the way down to net profit and then continue with what you're looking at here. Okay, simple, nothing to worry about. All right, now let us look at these entries that we see here and break them down. Interest on drawings. There are times when partners borrow from the partnership. Now, interest on what they borrow is a source of revenue to the partnership agreement, and that is why it is added. Remember, it's revenue, so revenue must always be added. The same way you add revenue to gross profit when you're doing the income statement, you add interest on drawings to net profit in the appropriation account. And once again, remember that interest on drawings is revenue to the partnership agreement, and that's why it is added. Interest on capital and salary are rewards. Yes, we can say that. They are rewards paid to the partners outside of their share of profits. In addition to that, that reward is taken from profits, and that is why it is subtracted. So interest on capital, that comes from profits. Salary comes from profits. As such, they are subtracted. And lastly, share of profits. Now, when you have added interest on drawings, if any, and when you have dealt with interest on capital and salary, what is left is the final net profit. And that is what is shared between partners in their profit and loss sharing ratio, or if it is shared equally, whichever the case may be. Let us use this example to make things a little clearer. Jamir and Kashmir have been in partnership, sharing profits and losses in the ratio 60%, 40%. That means Jamir gets 60 and Kashmir gets 40. They are entitled to a 5% increase on capital per annum. Jamir having a capital balance of 30,000, Kashmir having a capital balance of 45,000. Jamir is paid an annual salary of $5,000. Interest is charged on drawings. Jamir is charged $1,000, while Kashmir is charged $1,500. The net profit before any of these was $75,000. Now, when we put all of this together, this is what our appropriation account would look like. So we start with net profit. And remember, everything above net profit, the income statement, it remains the same. Nothing changes. To the net profit, we add interest on drawings. Jamir was charged $1,000, Kashmir was charged $1,500. And remember, interest on drawings is added simply because it is revenue to the partnership agreement. Okay? Interest on capital, 5% for Jamir and 5% for Kashmir. Now, this 5% increase is calculated against their capital balance, which means 5% of 30,000 is 1,500. That's for Jameer. And 5% of 45,000 is 2,250. That's for Kashmir. Add the two together, bring it over in the second column, let it sit there for a while. Jameer is paid an annual salary of 5,000. Add the salary and the interest on capital, add them together, and bring them over in the third column. That is necessary because you will be subtracting these two figures from 77,500, but you can't do that in the second column. That is why you must add the two together, bring over the total amount to be subtracted, and then you can perform your subtraction. When that is done, we'll get a balance of 68,750. That represents the final profit. And that is the profit that will be shared between the two. Jameer gets 60% and Kashmir gets 40%. That's it. That is the appropriation account, the basic concept of the appropriation account. Simple, wasn't it? I thought so too. The third financial statement for partnerships is known as the Statement of Financial Position, aka the balance sheet. Now you should already be familiar with the Statement of Financial Position, aka the balance sheet. Now, taking the knowledge that you have of the Statement of Financial Position, remember that for partnerships, the fixed asset section, the current assets section, the current liability section, and the long-term liability section all remains the same. The only section that changes is the finance by section. And this is what it looks like. This is what it looks like. Now, let's break down what we're looking at here. The capital account balances for each partner comes first. Jameer had a balance of 30. Kashmir had a balance of 45. We add these two, carry over the total. Notice that these are on double lines, which means we're not going to trouble this again. That's permanent, that's fixed, that stays right there. Now, current account is where everything else for a partner is placed. So the capital account has their balance only. The current account is where everything else is placed. We're going to shed some more light on that in a second, but follow me carefully now. Okay, so Jameer's interest on capital was 1,500. His share of profits was 41,250, and his salary was 5,000. Add all of that together, and you get 47,750. From this, you subtract his drawings. This is usually additional information. His drawings of 5,000 and his interest on drawings of 1,000. You take 6,000, which is this 5,000 and this 1,000, from 47,750, and it gives you 41,750. Let that sit for a second. Over to Kashmir. His interest on capital was 2,250. His share of profits was 27,500, and he did not receive any salary. Add those two together, you get 29,750. From this, you take his drawings, which was 5,500. Once again, this is usually additional information given to you. And his interest in drawings, just 1,500. You take these two figures, 5,500 and 1,500, from 29,750, and it gives you 22,750. Then you add these two current account balances together, Jameer's and Kashmir's, to 41,750 22,750, and it gives you a total of 64,500. Then lastly, you add the 64,500 to the 75,000, and it gives you a grand total of 139,500. Now this figure on this double line right here should be the same figure at the end of dealing with the other four sections. Because remember, the balance sheet usually have two figures on double lines. This is the figure down by the finance by section, and this should match with the other figure at the top section. In other words, this represents capital employed. At the top of your balance sheet on the first double line, that represents total assets. Now remember the concept of the statement of the financial position. Total assets and capital employed must be the same in order to balance the statement. Okay? That's it. Let me say it again. Remember, this represents capital employed. At the end of the other four sections at the top, on the first double line, as you're used to it, that represents total assets. Now the total assets figure and capital employed should be the same to balance the statement. Outside of that, everything about the statement of financial position remains the same. No major changes. There are two possible ways in which the capital accounts for partnerships can be accounted for. There is the fixed capital account method and the fluctuating capital account method. Let's start with the fixed. The fixed capital account system is one in which the capital account balance for each partner is placed in an account. That balance remains in the account and is balanced off each year. Nothing else is placed in that account. This would be Jameer's capital account. His capital balance of $30,000 is placed therein. This is Kashmir's capital account. His balance of $45,000 is placed in it. Nothing else is placed in this T account. Only their capital account balances are placed in there. So at the end of each year or each month, whenever balancing off process is done, it will just be balanced off, brought down to the next month or the next year, and it continues. Nothing else is placed in this account. Everything else is placed in a separate account called the current account. This is what their current account would look like. I take it that you are wondering why these things are on the credit side and why these things are on the debit side. What determines what goes where? Let me offer you a simple explanation. Recall the double entry rule for capital. When capital increases, you credit, and when capital decreases, you debit. With that understanding, all these things over here, they increase the partner's capital. And all these things over here, these two, they decrease the partner's capital. When capital decreases, debit. When capital increases, you credit. That's it. So once again, for the fixed capital account, the capital balance is placed in a separate account by itself, and everything else is placed in a current account. And these two would be the current accounts for Jameer and Kashmir. There is also what is called the fixed columnar format. And that is where all the information for both partners are placed in one columnar account. So you see here you have date, details, Jameer, and Kashmir. It is still one capital account with only their capital information. The only difference is two accounts are merged in one and separated by columns. The same concept applies here. All of the current account information for Jameer and Kashmir, all in one place, separated by columns. That's the columnar format. The fluctuating capital account method is the method where all entries that are necessary for a partner is placed in one capital account. Everything in one place. This is Jameer's capital account. All entries relating to Jameer is in one place. This is his capital balance, 30,000. And everything else at the appropriate time is placed there. Now, this method is called the fluctuating method simply because the capital balance will change every year. When the account is being balanced, the balance on the account is going to change every time. Now, recall when we were doing the fixed method that Jameer's capital account was fixed at $30,000 every year. Now, with the fluctuating method, notice that his balance is $71,750. That is so because everything is in the one account. And next year, when his account is done again, the balance is going to change. Why? Because salary may be different, share of profits may be different, interest on drawings or his drawings may be different. And as a result of that difference, the balance is going to be different. Same thing for Kashmir. In the fixed method, Kashmir's capital balance on his account was 45,000. Now it is 67,750. Why? Because all entries are in one place. And the same applies to Kashmir. Next year when his account is calculated, this balance may very well change because there might be a change in his interest on drawings, his drawings, or his share of profits. And that is why this concept is called the fluctuating capital account. Finally, this is the fluctuating columnar format. Same concept as fixed. Everything that is supposed to be there is there, but is separated by columns. So you have all of the information for Jameer and Kashmir separated by columns. Jameer's balance remains the same, Kashmir's balance remains the same. What this does, the columnar format that is, it provides a simpler way to report the information. Instead of opening multiple accounts, you just draw up one columnar account, place all the information in one place for both partners. That's it for today. That takes us to the end of partnership accounts. I hope the information was clear and I hope that you learned something. If you enjoyed that video, please leave a thumbs up and subscribe and share and comment. And remember, if you have a question or a concern, please feel free to comment in the comments section below and I will respond to you directly. Until next time, walk good, stay safe.